Namaskaram friends. So in this video, I am going to talk about federal funds rate. What federal fund rate? It is basically dealing with the Fed Reserve of USA, how they make their economy or policy of the economy so that they control the money supply and they not directly interfere in the federal fund rate. Like in India, RBI tweak the repo rate. That means a rate on which RBI give money to the banks. So it is like in USA. USA do not directly interfere in the federal fund rate, but in India, RBI did in repo rate. So federal fund rate basically overnight lending of money from one commercial bank to another commercial bank. And we know that if money supply is less in the market, so the commercial bank charge higher interest rate when they lend money, and also if when they give money to the people, they charge higher interest rate. So federal you can say Fed of the USA not directly interfere with the federal fund rate FFR, but it interfere with it try to interfere in the market by controlling the money supply. And if money supply is less in the market, so federal commercial bank give money to the people on a higher interest rate. So Fed tried to control the whole phenomena by supplying less money in the market. So in this video, we are going to talk about federal fund rate and its relation with Fed. It's related with the repo rate of RBI and in the whole economy, how these things are going on. So federal fund rate. What is federal fund rate and how does US Fed tweak it? Okay, so basically FFR and how US Fed tweak it. So the FFR is the interest rate. Basically, FFR is the interest rate. Federal fund rate is the interest rate at which commercial bank in the US. Remember, commercial bank in the US, not government banks. Commercial bank in the US borrow from each other overnight. So FFR is the interest rate at which commercial bank borrow from each other overnight. So it is basically interest rate. At that interest rate, commercial bank borrow from each other overnight. Remember, overnight interest rate and commercial bank. Arguably, if banks borrow at higher rate from each other, they will also lend the money to consumer at a higher rate. Very easy. Okay. If any commercial bank borrow at 8% interest rate, so if it lend to the money to the consumer, it also give at a higher interest. Earlier, if it give to the 9%, now it is give to 10% because it borrow at a higher interest rate. Now, unlike in India, where the RBI decide what the repo rate or the interest rate at which the repo rate means interest rate at which the RBI lend money to the bank. So, unlike in India, remember, unlike in India, where the RBI decide what the repo rate will be, in the US, the Fed cannot directly specify the FFR. So, in US, the Fed cannot directly specify what FFR is, but India RBI decide what repo rate is. So, there's a difference between RBI as well as US Fed. Repo rate as a FFR. Instead, try to target the FFR by controlling the money supply. It not directly specified what FFR is, but try to target the FFR by controlling the money supply. So when Fed want to raise the prevailing interest rate, so if Fed want to raise the prevailing interest rate, that means at a higher interest rate, company borrow money from each other. So in the US economy, it reduces the money supply. So if Fed want to prevail the interest rate, so it reduced the money in the market. So if it reduced the money in the market, commercial bank borrow from each other overnight because there is less money in the market. And when they lend money to the consumer, it also give that money to the consumer at a higher interest rate. So it can't directly interfere in the FFR, but try to raise the prevailing interest rate by controlling the money supply in the market. So this forces every bank. If there is less money in the market, so it forces every bank in the economy to charge higher interest rate. Not only commercial bank, every bank, because there is less money in the market. So every bank lend money to the consumer on a higher interest rate. The process start with commercial bank charging higher interest rate to lend each other for overnight loan. So there many processes, but it start basically with commercial bank lend money to each other on a higher interest rate. Other banks charge later, or you can say earlier or later, and other things are going on the when supply of money is less in the market, but it start with the lending of commercial bank to each other on a higher interest rate. So I hope you understand the whole idea of FFR, its relation with repo rate of India, role of RBI, role of US Fed, how commercial bank charging more money if money supply is less in the market, and when they give this money to the consumer, they also charge higher interest rate. US Fed don't directly specify what FFR is, but if it try to raise the prevailing interest rate, uh, it reduces the money supply in the market. So I hope you understand the whole idea of FFR. So now we are going to solve one question based on it. And in this picture, you can clearly see US Congress, dollars, and US Fed dealing with the economy of USA. So now try to solve one question based on FFR. The FFR is the interest rate at which commercial bank in the US borrow money from each other overnight. Remember, this term is very important. Overnight commercial bank, USA and FFR. So this one is correct. Like in India, where the RBI decides the repo rate, the federal directly specifies the federal fund rate. No, this one is wrong. Next one is when the Federal Reserve want to raise the prevailing interest rate in the US economy, it reduces the money supply. So when the Federal Reserve of the USA want to raise the prevailing interest rate in the US economy, it reduces the money supply. Yes, when it reduces the money supply, there is less money in the market. So commercial bank lend money to each other on a higher interest rate, and when they lend money to the consumer, it also charge higher interest rate from the consumer. So this one is also correct. That means statement 1 and statement 3 is correct. That means option B is correct. Just check we are on the right path or not. So option B is correct. That means we are on the right path. So I hope you love this video, you enjoy this video related to FFR and its important in significance in the economy of the USA and in the economy of the whole world. So namaskaram. Thank you.